We're here to talk about Silicon Valley real estate market analytics on July 20th, then followed up by the Greater Bay Area, which is 13 counties, 5 regions. The goal here is for you, the consumer, to better understand what's going on in the real estate market and help you make a better investment. And we'll come back to under how to participate if you want to know how to get handouts and all that kind of stuff. I'm Richard Kelly in Creekside, really working with buyers or sellers here in Silicon Valley. Here's a summary slide. What we're doing here is we're showing 5 key indicators, and the color combinations here are consistent. Blue is an ice cold buyer's market, red is a hot seller's marketplace, and the gray line is a neutral marketplace. Real estate is very cyclical. It has an annual cycle, it's got a weekly cycle. What you want to do is you don't want to know what the changes in the market are relative to last month or last week. You want to know what the changes are relative to where they typically are. And that's what this is doing. The gray line is the typical. The typical is defined as the median for the past 10 years for the same week. So we'll look at the inventory for the past 10 years on the week that ended on Thursday night, midnight, gather the data on July the 19th. And that week going back for the past 10 years, plotting out what the median is. So we started off with 82%, and this is 14 weeks ago, a quarter ago, with both bookends. We were at 80% of the normal level of inventory, and the volume was 1850. The volume is growing to 2526 because inventory normally grows. As you can see, the gray line is sloping up, and right now you're at 83%. So you've gained 3 percentage points, which isn't a lot of gain, but you've gained almost 50% of your inventory. And that's why it's important to know what the market typically is doing. Likewise, on offers, we started off at 69% of the offers expected, and we're now at 80% of the offers expected, which, is a fairly significant increase, but the number of offers accepted has changed very little. You've gone from 1,900 to only 2,000. So you've only gained 100. Basically doing is saying the percentage from the gray line down to the purple line is 70%. And you can see it is a fairly large gap, and the gap now is smaller over here. And so the number is probably correct. I have no reason to believe it's wrong. But the other thing to keep in mind is the blue line is an ice cold marketplace. So there's been a lack of offers, although the lack of offers has improved a little bit, and we actually got up to the blue line, and we're a little bit below, and we're approaching the blue line again from the bottom side. So there's clearly a lack of offers. Now we look at the DUI. This is the seller-buyer balance, the speed of the marketplace, how much pressure the buyers are going to feel. Again, the gray line is typical. Here you're a little bit above the gray line towards the blue, so it's a little slower than it normally is. You can see we started off at 34 days, and that was 13% slower than it normally is. Now we're only 9% slower, but the market is 6 days slower. It's almost 40 days. So the market is slower as far as the overall speed, but it's actually faster relative to normal because the market normally slows down. So again, what you really want to be doing is comparing the data to the gray line. Days on market. This is the 75th percentile. So 3/4 of the sellers are selling quicker than 14 days, now quicker than 20 days. That's a huge slowdown going from 2 weeks to 3 weeks. And we've also gone from 85%, so faster than normal. And that's why it's on the purple line. The data line is on the red side of the gray line. And now we're basically at 100% of normal. You can see that we've gained a whole week longer marketing time, and we've now are taking basically the amount of time that you normally do. So the market was, even though there was lack of inventory and a lack of offers, the lack of offers was less than the lack of inventory, leading for a faster marketplace at 85%. Now you're at 100%, so the market's taking that longer period of time, and you're up to 3 weeks. It's not the fact that really that we went from 14 days to 20, because that would be a completely normal marketplace. It's the fact that we went from 85% to 100%. Now looking at seller price reductions, this is what the seller's doing with their own asking price in order to get the offer to come in the door. Typically at the beginning of the quarter, and this is a moving quarter, not the calendar quarter, it's 14 weeks ago, sellers were taking 0.3 of a price reduction. At this time of the year, they're normally taking a 1.1%, almost a 4 time increase in the amount of price reductions, and these price reductions are fairly small. But again, at the beginning of the quarter, the 12% price reductions, more than normal, now 41%. And the percentage is measured from the distance from the gray line. So you can see the distance from the gray line versus the distance from the gray line isn't as much over here. And typically the gray line is showing an increasing amount of price reductions. This is clearly a time of the year when the market typically slows. In my opinion, and based on my looking at this data, the peak of the marketplace, the most activity is basically typically mid-March to mid-April. This year it was April 19th or April 26th, depending on which data point you want to rely the most on. Now, overbidding is not a leading indicator. It's actually a lagging indicator, but it's on here because there's a high level of interest and it shows the offer competitiveness. It was 2.9% more overbidding than typical because you can see the overbidding, the purple line, the data line is above the gray line. So 3% basically more overbidding than normal. And we were at 9.5%. So normally the amount of overbidding would have been about 6.5%, and now it was 9.5%. Now your normal overbidding is 6.7%, and we're basically no percentages more than normal. So we're at 6.7% overbidding. We've gone from almost 110% down to 107%. So a 3% reduction in the overbidding relative to the seller's individual asking price. And you can see the decreases happened in the last couple of weeks. And if you count back, this is basically the current week, back 1 week, back 2 weeks, back 3 weeks ago. So for the past 3 weeks, it's really dropped. But in order to get sale price, you need to have the escrows closed. So that data is actually 6 to 8 weeks old. So it's much older than it would indicate just looking at the line on the data. Now we're looking at all of Silicon Valley. So this is Santa Clara County, San Mateo County, and Alameda County, all in a blender. The purple line is the level of inventory. So you can see that we're at about 83% of the inventory that you would expect for this time of the year. The offers on the orange line is somewhere around 75%. That is less offers than inventory, leading to a higher DUI at about 9%, 109%, 9% slower than it typically is. And that just gives you an idea, and you can see how much fluctuation there is. On the vast majority of my time over time slots, to go back to 2014, the initial stuff on the left-hand side is more compressed. Then I do 2023 for a full year on a more expanded cycle, and I have the current year 2024 on that same expanded cycle. The purpose of this is to let you see what the annual cycle is visually, but then also fit more data on and allow you to see the changes in the marketplace in the current year. Now we're doing something a little bit different. We're looking at the distribution of days on market. So we're essentially looking at every transaction for every week. We're starting off a year ago, July 19th, 2023. We're then jump up by about a month, which means I'm going 4 or 5 weeks. I do not use calendar months for anything. Everything I do is on a weekly basis because I believe real estate is very heavily dependent on weekend open houses, at least in the local marketplace. And so you may as well have your measurements based on what's happening. You get a lot less statistical fluctuation. The problem is you have some months with 5 weekends, some months with 4 weekends, and it's not the weekends that are important. It's the number of weekdays after the weekend, because most offers are presented and accepted basically Tuesday through Friday of the week after the open houses. So those are the key days, and that varies depending on your calendar month. And therefore I look at weekly data. Then to get enough data to be statistically significant, I use a 5-week moving period of time. I call that my monthly data, but it's 5 weeks and it moves every week, and it starts on March 1st of every year and jumps forward 7 days, 1 week at a time. Then it leaps around to February. On February 21st, it jumps forward 8 days to back to March 1st. On regular years, on leap years, it jumps forward 9 days. That's why I start with a March 1st calendar for doing my analysis, is we already have the discontinuity in February, and you have 1 extra day or 2 extra days in a year, depending on whether it's leap year or not. Therefore, I made my discontinuities at one place by starting with a real estate fiscal year of March 1st. And that's why this will always be July 19th. And then what we do is we jump 4 or 5 weeks together. The oldest lines are dotted, the more recent lines are dashed. and the most current lines are the solid lines. So let's just step through this and see what's happening. You can see that you were basically slowing down. You're right there. Now you jumped up here. Now you didn't jump. That's the slowest we were. Now you've improved in the spring. And right about there, April 19th was sort of the peak of the market. April 26th was the same. And now you can see you're starting to plateau, and now you're going to start moving down. See, there's your first significant jump, and now you've been moving down, and the purple line is going to be coming up, and that's going to be your current data. And you can see you're just slowing down and slowing down. And I didn't mention this at the beginning of the slide, but the blue dash dotted line down here is a year ago data, July 19th, 2023. The purple line is the current data. So you can see this year is slower than last year. So the market is slower than last year. The blue dashed line at the top here is the coolest market on data I ever had, which was on December 27th, 2022, not even 2 years ago. And the hottest we ever had was Valentine's Day of 2022, just before the market started cooling off in 2022, as we all remember. Now we're doing the same type of thing, and we're looking at sellers' ask price reductions. So this is how much sellers are doing a price reductions, and we only look at the 17.5% of the sellers that are taking the biggest price reductions, and we go down to 2.5. So we're looking at 15% of the marketplace, which isn't much, but that's where all the price reductions are doing. In fact, you can see my best line up here, the red dashed line, had no price reductions whatsoever in 97.5% of the sellers. And the blue dashed line down here is the worst week we ever had, where 5% of the sellers were taking a 15% price reduction, or 10% of the sellers were taking an 11% price reduction. And so anyway, the blue dotted dashed line is where we were a year ago. This year is cooler than last year because it's closer to the blue line, starting from a year ago, and now you're seeing the slowdown. So you'd expect the market to be slowing down at this time of the year. Then you had the spring run up, a little bit of a bounce there. There was a big jump 5 months ago, 4 months ago. Right about there's the peak. That's actually April the 12th. The second one was April 26th. Now you can see you've been slowing down. And so this is saying sellers are taking more and more price reductions. And the amount of price reductions aren't huge. You know, it's only 15% of the sellers are participating in the price reductions. And most of the people are taking, you know, somewhere around 7-8% price reductions. You know, the most ones up here are 13% currently. 2.5% of the sellers are taking 13%. 7.5% of the sellers are taking 7%. You get down here to 17.5%, and you're already up to 0% of the sellers are taking anything. Basically, 84% of the sellers aren't adjusting their price at all, and this is the amount that they're adjusting them. Now we're looking at the flip side, and we're looking at overbidding. And the first thing I'll point out now is the blue line and the purple dashed line are right on top of one another. So this year is just as hot or just as cold as last year. I suspect what we're going to do is see that the purple line is going to start moving below the blue line going forward. If you were with me last week, you'll remember that the purple line on this slide was above. So we've gone from above to equal, and maybe as early as next week we'll be below. And that's just following what the market's already done. This is already in the bank, so to speak. The escrows are there, whatever they are is what they are, and we won't know that information until they close. So stepping through and going a week at a time, you can see that we're sort of not doing much, and then we're going to go down for the end of the year slowdown. So there's your slowdown for the end of the year. There's sort of the bottom. Now you're going to do the spring run up. There's a big jump. Now you're going to see a lot of plateau, and the plateau is as early as April the 26th, but the sale price is sort of closer to that plateau for a long period of time, because now you're still at May 27th, 24th, and it was still up there. Now it's starting to move down, and you can start seeing the bigger decreases. So just like the ask prices became bigger, I'd expect these bigger sale price reductions to be there. But again, what it's saying is 25% of the sellers are getting about 12% above what their asking price. You come out here, and basically some number right around 80% of the sellers are getting above their asking price, which means about 20% of the sellers are getting less than their asking price. and you can see that that period moves a little bit, and is a fair amount right at asking price. So basically from 70%, looking at the purple line, from 70% to about 77%. So about 7% of the sellers are getting exactly their asking price. And then from 77% up to 100% is getting less than their asking price. Now what we're doing is sort of looking at this key indicators over time. What's happening with inventory? You can see inventory had a big fluctuation on July the 4th. This is bigger than typical. I believe that was related to the holiday being in the middle of the week, people wanting to be wherever they were going on Thursday, so they were taking Wednesday off anyway. So it appears that a fair number of people took Monday and Tuesday off and made it a full week holiday. So the impact on real estate is negative for holidays, except for Mother's Day and Valentine's Day, which has a slight positive impact. And that's because real estate is an optional event. With July 4th being a bigger event this year, the decrease was bigger than typical. Now you've basically recovered and you're going to grow. But if you look at the market overall, right about now is when the peak of the marketplace is. So we may be higher next week and then roll over, or we may actually roll over next week. But we're basically where you'd expect the most inventory for the year. And you can see it sort of stays fairly level through the end of third quarter, but come October 1st, it just falls off like a rock, and it's actually closer to Halloween where it really starts dropping. So here's now taking that gray line you saw, stretching it out, and then looking at what the data does compare to that. So you have less inventory than normal, which would favor the seller, which is why it's shaded pink. And you can see the big dip we hit for July the 4th. It went up a little bit and then down a little bit. So that's compared to normal. We actually lost a little bit of inventory compared to normal last week, which would tend to indicate to me that it's more likely to roll over next week. Now we're looking at offers, and here you can see that the offers were starting to move away from the blue line, but sort of the same pattern as the blue line. And now they've fallen down and they're right back at the blue line. And even this week, I would actually say is below the blue line. So we're selling less inventory, less transactions than we would expect, even in a slow marketplace. You'd expect to be up here somewhere around 2,700, maybe 2,800 units, and we're only selling about 2,050. That's a loss of about 750 transactions every 5 weeks. That's pretty significant. That's, I do my math real quick, 125 fewer transactions every single week in just Santa Clara County, San Mateo, and Alameda counties. And here you can see compared to normal, you have the offers accepted and you're down here around 75%. You can see that we were as high as 80%, but you can see in the recent past, we've had a complete lack of offers. So we're losing a lot of transactions. That impacts the title industry, the lenders, the termite inspectors, the home inspectors. There's just fewer transactions. Here's now looking at the speed of the market, the ratio between the supply and demand. This is sort of how much froth there is in the marketplace out there. And you can see the July 4th slowdown there, and then you've basically recovered and we're slowing down. So we're between the gray line, which is where you'd expect the market to be, and the blue line, which is the slowest you'd expect the market to be. So buyers have a little bit more time, but still it's pretty fast paced, 42 days or something like that, 43. That's how long it would take to sell all the existing inventory at the existing rate of sales, assuming no new inventory came on. Or if you had a steady state marketplace, which clearly we never do, that would be how long it would take to sell the typical property, but we never achieve that. And here you can see the gray line is where you'd expect the market to be at 100%. And where we are right now is about 109.5%. So 9.5% slower, a little slower pace. It doesn't mean the market's slow. It just means it's slower than it typically is at this time of the year. Silicon Valley tends to be a very fast-paced real estate market, and therefore you can be 10% slower and still be fast-paced. Looking at the seller's time on the marketplace is how long it's taking. The 3 out of 4 sellers are selling in 20 days, which is exactly right on the gray line. So we're absolutely typical. You can see that this isn't the best metric because of these step functions here. You want to have a smooth graph, and I am working on something that will measure the percentage of market that sells before one weekend, after one weekend, and after 2 weekends, and come up with an index that I think is going to be pretty telling. fine tuning it on the magnitude of my weighted averages at the moment. Here's doing the same thing, pulling out the line, and you can see we're basically right there at typical. You can see the July 4th holiday really had a huge impact on it. Every holiday has a major impact. You can see the end of the year holiday every year having a huge impact on real estate. Real estate's that optional event. People get busy with other things. This is seller ask price reductions, and this is the average reduction. You'd expect to be on the gray line up here with basically about 0.8% reduction. Right now, we're about 1.1%, so 0.3% more reduction than typical. Less reductions than you would expect in the slowest marketplace, which would be about 1.6. So this is a very tight metric, but you can still see the trend. You're between the gray line and the blue line, which means it's more price reductions are happening than you'd expect in a typical marketplace. And here you are showing it's sort of on the cool side, taking more price reductions than typical. Here's the frequency of overbidding. Gray line is absolute normal. You're doing more price reductions, so you're above that, you're towards the blue line, and it's the vertical spacing, not the horizontal spacing, but the vertical spacing. So from some point right about there to there versus some number up about here. So you can see you're quite a ways away from the blue and you're pretty close to the gray. And here you can see you're pretty close to the gray. You're somewhere about 18% more price reductions, and this is frequency. So if you had 10% typical price reduction, 18% more would be 11.8% of the sellers are doing price reductions. So it's nowhere near where we were in 2023 or racing as the market slowed down in 2022. You can see we basically had almost no sellers taking price reductions, and then it slammed down all the way up here to where we were 200% of the sellers that typically do. So 15% of the sellers were typically taking price reductions, 30% of the sellers were doing price reductions. So you can really see the change. Right now, you're sort of in the normal bandwidth of where you'd expect the market to be. Here's the magnitude of overbidding. So this is how much on average the buyers are overbidding. Now look at the slowdown. You've gone from an 8% overbid for the whole Silicon Valley. Santa Clara County, we'll see later, has the highest overbidding, down to 4%. So you've lost 4% of the overbidding right there in just a few short weeks. That's about a quarter, maybe it's less than a quarter. So maybe in the last 10 weeks, 8 weeks, you've lost 4% of the value of offers just based on the amount buyers are overbidding. And you're getting pretty close to the gray line, which is normal. And here you can see the huge percentage down. So the slowdown is much more rapid than it typically is. And you can see you're right at 100%. But notice the slope of that. There's no indication that that's going to stop. So we're going to continue to go down, or the magnitude of overbidding is going to be less than it typically is fairly shortly. This is the frequency of overbidding. Again, it's right on the normal. So sellers are basically right at 70% of the sellers are getting more than their asking price. But again, based on the steepness of this, I would expect it to continue and shortly be below. And even in the typical year, in another 13 weeks from now or so, you're 60% of the buyers are overbidding. So you've lost another 10%. And here you can see the relative to normal. You were at the beginning of this quarter, which is only on basically July the 1st, you were up here in the pink at somewhere around 7% more overbidding than typical. And now you're right at the level of overbidding you'd expect. Here's sale price. This is on log paper. I prefer log paper because now you can draw a straight line and get your appreciation. There's a couple of major takeaways. You can see the dip down at the end of the year. So that's sort of the ideal time to close. Now you got to remember that's closing. So the offers were negotiated before that. But at the end of the year, there's very little inventory. So you can't be picky on what you want if you want to get that run up. When you don't want to buy is basically typically right here in second quarter. So we're off the period of time when you don't want to buy, because that's when prices are high. And you can see that right here, second quarter, prices in the current year were at high, and you can see that we're now dropping down. We will more than likely go below that long-term slope depreciation line. And then next year we'll turn around and do the whole thing over again. So you can see pricing is very cyclic. Here is your estimated payments. Here I'm assuming an 80% loan using the Federal Reserve average interest rate. This is the cheapest 10 percentile in Silicon Valley. This is your typical median priced home right at $13,000 a month payment. And it would be very rare, but if the person buying the most expensive 90 percentile home did an 80% loan, their payment would be 26,500 roughly a month. Here is now looking at the three counties. Santa Clara County is in the blue, Alameda County is in the gray, San Mateo County is in the orange. San Mateo County has the least typically because it's the smallest county, but it's basically right at the level of inventory you'd expect. Santa Clara is basically below the level you'd expect, but sort of the same magnitude we have been in other limited inventory years, not where you would be in a normal year. And Alameda County is sort of the same as Santa Clara, but Alameda has more inventory now relative to Santa Clara, where typically the two are fairly close together. There is this major exception in the second half of 2017 through the first half of 2018, where Silicon Valley did a double year of appreciation. And, I haven't seen that before or since, and only Santa Clara County participated in that bizarre behavior. Here's the offers accepted. You can see that Santa Clara County, even though it had less inventory, is selling more offers. So it's a faster paced market than Alameda County. And that's going to be interesting in a second. And you can see that San Mateo County, even though it had normal inventory, its number of offers is below where it typically is, which means it's a slower paced market. Here's your days on sold inventory. So Santa Clara County is the fastest. San Mateo and Alameda County are slower, but still less than 50 days, which is basically somewhere around 42 days is where I consider going into a balanced market up to 80. So it's clearly still not a buyer's marketplace, but more a balanced marketplace. Santa Clara County would still be in what I consider to be a seller's marketplace based on the speed. Here's marketing time. Santa Clara County at basically 22 days, just over 3 weeks. And then you have Alameda County and San Mateo County up here at 28 days at 4 weeks. That's the time it takes 3/4 of the sellers to sell. So only 25% of the sellers still are on the market after 4 weeks. Here's your average price reductions. You can see Alameda County has the most price reductions, which is a little surprising. And Santa Clara County, which is what I would expect, has the least, and San Mateo County in the orange is in second place. And you can see not huge price reductions in Santa Clara County. It's about 0.7%. In San Mateo County, it's about 1.2%. And Alameda County is 1.5%. Here's the frequency. Alameda County has the most price reductions at 20%. Santa Clara and San Mateo County are tied at about 14% of the sellers doing price reductions. Here's looking at the average overbidding, and this is the buyers. So, and this is where it's interesting. It's Alameda County was much slower than Santa Clara, but Alameda County has the most overbidding. So overbidding is more common or more magnitude in Alameda County at 8% overbidding than San Mateo or Santa Clara at only 6%. Normally, you'd expect that to be in relationship to the speed of the marketplace, and clearly, right at the moment, that is not the case. Here's the frequency of overbidding. Santa Clara and Alameda County have the same overbidding. San Mateo has the least amount of overbidding, but so San Mateo County, for the magnitude to come out the same as Santa Clara, the magnitude in San Mateo County has to be greater than the magnitude of overbidding in Santa Clara, because there's a smaller percentage of the marketplace is overbidding. Here's your long-term appreciation. You can see Santa Clara County's got the highest appreciation. San Mateo and Alameda County are basically tied. This is 80% appreciation since 2015. Santa Clara County's had a little bit over 100% appreciation since 2015. Here's the price on log paper. This is just so you can come back and see that prices in San Mateo County are below their peak in 2022, as well as sort of right at their peak in 2021. Santa Clara County, on the other hand, is right at their peak in 2022 and significantly above their peak in 2021. And Alameda County is sort of in between the two, where the amount under in 2022 is greater than Santa Clara County, but probably less than San Mateo, and it's above but close to its 2021 peak pricing. So you can see there are going to be some people that are still upside down, but if you had purchased here or here, you would have been doing a whole lot better. Here's the same information on regular paper for those that prefer. And again, I have the spread out slide, so you can't draw a line through this to get your appreciation. Here's those estimated payments by county. So Alameda County is the most affordable, and San Mateo and Santa Clara County are actually pretty close. You can see they've been closer for a lot compared to where they typically are. Typically, there's a fair amount of separation. Here's a summary of micro markets. To me, micro markets are where it's important. Real estate's very local. Each micro market has different criteria. We can pick the Santa Clara, Willow Glen, Cambrian, Campbell area and go across, and you have red would be lack of inventory, but also lack of offers. Days on unsold inventory based on the 10-year median is 85%. So basically typical, a little bit on the hot side. The DUI right now is 25 days. That's actually a fast-paced marketplace. So even though based on the 10-year median and everything, DUI would be normal, here it's hot, 25 days, and anything from basically 6 weeks, 42 days, 77 days, 11 weeks is sort of the balanced marketplace. So at 25 days, it's clearly a pretty fast marketplace. But yet time on the market at 22 days is what I consider to be a balanced marketplace. Sellers are doing a 1% price adjustment. Only 16.7% of the sellers are doing any price adjustments. The average magnitude of overbidding is 6.4%. The frequency of overbidding is 71%, so almost 3/4 of the buyers are going in over their ask price. 94% appreciation since 2015. The cheapest 10 percentile home is 1.47. The median is 1.96, and the most expensive price is 2.6 million. And then these would be the corresponding rough estimates of payments, assuming an 80% loan. Here's it geographically on maps, so you can see it. Red's going to be favoring the seller, so you can see the center part of Silicon Valley is hot, and you can see the base cities in San Mateo County is hot as far as lack of inventory. Now you look at offers, and a bigger area is clearly lacking offers. The only area that has normal level of offers is sort of the Palo Alto, Mountain View, Cupertino area in Santa Clara County. This is the days of unsold inventory compared to normal. You can see that San Mateo County is much slower than normal. Saratoga, Los Gatos is hotter than normal, but everybody else is basically where they normally are, within 12% of normal. Here's the actual number. So this is the speed a buyer feels. The bulk of Silicon Valley is pretty pink, along with the base cities in San Mateo County. The slow area is basically the expensive areas in San Mateo County. Here's your time on marketplace. You can see the San Mateo County coast is the bluest at 75 days on the marketplace. Everybody else is either white or red in color, which would be a normal to fast-paced marketplace. It's more the outlying areas that are more affordable and now not as undesirable for their longer commutes. Here's the house price adjustments. The only area that's sort of really pink is East San Jose, the affordable areas, and also Foster City, but Foster City is a very small area, so you really can't take that into consideration. Here is the frequency of price reductions. So red is lack of price reductions. The only place that's doing a lot of price reductions is the San Mateo County coast, where 40% of the sellers are doing price reductions. Here's the magnitude of overbidding. Clearly, most people are going in over ask price. You can see the only area that is below is San Mateo County coast with a 2.3% price reduction. The expensive areas in San Mateo County are at 1% reduction, which is right approaching the threshold where I throw it over to start shading it blue in color. Frequency of overbidding, or least frequent, is the San Mateo County coast. The most is sort of the more affordable outlying areas, again, because of commute and affordability. Here's the appreciation. So the areas that have appreciated, I believe, most likely in the most recent past, basically since COVID, are your outlying areas. The areas that have appreciated the most recently are the ones that have the overall. You can see San Mateo County is really lagging behind on appreciation. Here's the sold price. So the affordable areas are the bluer color. Here, color is not hot and cold, but favoring the buyer because it's more affordable, favoring the seller because it's more expensive. You have the median price in the middle, as well as the cheapest 10 percentile and the most expensive 10 percentile in each of the areas. This is up there to show you the lack of, we're basically in the 9th and 8th lowest year. We were 10th, so we've improved a little bit, but you got to be careful because COVID was the worst year, and then 2023 was also a very bad year. Here's the actual data for Silicon Valley, then Santa Clara County, San Mateo, and Alameda County. You can look at the metric that is important to you. The number of new listings coming on the market is down, which means less inventory choices going forward. So we've been talking about Silicon Valley real estate market analytics, July 20th. We will be doing the Greater Bay Area in the 13 counties. The blue URL up here is my YouTube archive, or you can type in the green root URL here, which takes you to the same channel. If you focus on the green root URL and add 2024, you can get to the live presentation Saturday morning at 9 a.m. You add in H for handout 2024 0720, and you get the handout. It is posted. My goal is to get it up about 15 minutes beforehand. I did meet that today. So if you want to look at the charts instead of me yammering, you just can go there and print that out and look at it at your leisure. And if you want a shortcut to any specific episode, you just year, month, date, code, app, green root URL. I'm Richard Calhoun with Creekside Realty, working with buyers or sellers. Please consider subscribing, liking, and sharing my YouTube links. And with that, I'm open for any questions. Let me see if anyone's got an unmuted mic. Not seeing any unmuted mics. Moving on to talk about the Greater Bay Area, we have 5 regions. The first is Silicon Valley, which is Santa Clara, San Mateo, and Alameda County, which is what we've talked about extensively. We also add in the cities, San Francisco and Marin. North Bay being Sonoma, Napa, Solano, Contra Costa. Central Valley being San Joaquin and Sacramento, and your Central Coast being Santa Cruz and Monterey. And this is single family home and duet, no condos or townhouses. Inventory overall, you can see, is quite a bit lower than historical. Santa Clara County is closer to normal levels than is on the North Bay or the Central Valley, both of which are normally the largest areas and therefore the most inventory. Some number up here close to 5,000, even in the years right immediately following the pandemic, they were basically at 4,000, and currently they're at about 2,500 and 3,000. So clearly a lack of inventory. Silicon Valley is down not as much. Central Coast is down a little bit, and the city, San Francisco and Marin, is also down a little bit. Now, if you look at the number of offers are also down. But if you start looking at the North Bay, it's actually getting pretty reasonable. It's down a little bit. I would say that historically the number is probably somewhere around 2,300, and right now the number is 1,900. So there's still a 20% shortage, but it's getting in the right magnitude. What I find interesting is Silicon Valley has clearly been coming down, and it's been coming down since about halfway through second quarter, where if you look at the other 5 regions, they're either flat or even down here, they're still going up a little bit. So your North Bay, your Central Valley are going up steeply. Your cities, San Francisco and Marin, is basically leveling off, and the Central Coast is sort of on a slow, steady climb and probably about ready to level off. So the only area going down rapidly in the number of offers is Silicon Valley. If you look at days of unsold inventory, Silicon Valley is going up. The other areas are coming down, except for Central Coast, which is on a slow up. There's a lot of differences here in the 5 regions, which indicates to me that real estate is local, and what is happening on the national level, what's happening in the 9 Bay Area counties is irrelevant. You want to know what's going on in your own neighborhood. It is important to know what's going on in the global to see that Silicon Valley is slowing down. If Silicon Valley typically leads the area, that would tend to indicate that the other areas are going to slow down in the near future. Marketing time, all 5 regions marketing time has been increasing, so that's pretty clear, but there's also a very heavy cycle in the marketing time. If you look at this, the peak is basically right at the beginning of the new year. That's basically because you're looking in the rearview mirror to get sample size, but basically as soon as the new listings come on after the first of the year, the marketing time goes down and then basically hits a bottom right around the end of first quarter, beginning of second quarter, and then basically continues to slow up. We basically have had that same trend. We were basically flat for all of second quarter, but now that we're getting into third quarter, they're up. And I would actually say about the last third of second quarter, all the areas have been slowing down, which is pretty much what you'd expect. Now, if you look at seller price reductions, all the areas are increasing their amount of their price reductions. So they're all in the downward direction. They've all been in the downward direction again, probably since about the middle of April. April 19th and April 26th is sort of the peak of the marketplace this year, I believe. And then if you look at the frequency of price reductions, they're increasing in all the regions. And again, if you come back and look at the cycle, it's very typical of seasonal cycle. So that's why it's important to look at what the season is. You don't want to just see that the rate's going up, because if you looked at just the rate going up, that would be more alarming than seeing the rate goes up every single year at this time of the year. So you have to compare to normal. Here's your magnitude of overbidding, and overbidding is going down in all the regions. And again, that's following the normal pattern. Also, just want to point out again real quick, this is an expanded x-axis, horizontal axis. So the 2023 and 2024, the x-axis, the date line is more spread out, so you can see the trend more carefully, and still it's more condensed if you go back before January 1st of 2023, and that's so that I can show you 10 years worth of history on here. But again, all the areas are going down, so the magnitude of overbidding is becoming less prevalent. Here's the frequency of overbidding, and the frequency is also going down. So it's becoming less common for sellers to get overbidding. The last region to turn down was the Central Coast area. The first one to make the marked sharp was the city, San Francisco and Marin, and Silicon Valley was not far behind, but so was Central Valley and the North Bay. Here's your long-term appreciation. The big takeaway is San Francisco and Marin have basically done the worst. Silicon Valley used to be by itself, but now it's right there with the cluster along with Central Valley, Central Coast. So North Bay is sort of in between the cities and the other three regions. But, even if you take a look at this, 70% appreciation since 2015 isn't bad. Even coming down to the cities with 40% appreciation in under 10 years isn't bad. That works out to probably something like 3% compounded annually. But remember, when you buy a house, you're leveraged. So you may only be putting 10 or 20% down. So you're getting a 5 to 10 times return on your own investment. Here's the sell price for the different areas. And you can see they're all basically up, but they also have an annual cycle. You can see that more clearly when I was doing the Silicon Valley earlier and had it on log paper. I do want to point out that Silicon Valley price is higher than the city's price, which is unusual, but it's been happening a couple times. The big notable time was right through here in midway through 2023. But again, Silicon Valley is more expensive than San Francisco and Marin. And generally, you can see the trend there is up. Here's the monthly payments. They're going to be in the same order. So that puts Silicon Valley as the most expensive region, followed by the cities, followed by the Central Coast, followed by the North Bay, and the Central Valley being the most affordable. Part of the reason the payments are going down is interest rates have fallen. The Federal Reserve rate was 6.77%. Here's the actual raw numbers for each one of the counties and also Silicon Valley. And then you can look across the top for the specific metric that you find the most valuable. And instead of following just the median sale price, I follow the cheapest 10 percentile as well as the most expensive 10 percentile. And with that, we're done. I'm Richard Calhoun, Creekside Realty, working with buyers or sellers here in the Silicon Valley. Please consider sharing, liking, and subscribing. Have a great day.